Some investors are still wondering whether now is the time to buy. Institutions, they're not wondering. They're mapping their acquisitions by zip code because the next 24 months will trigger the biggest transfer of ownership in American multifamily history. And this video is your map. You won't find this data in glossy brochures. You'll find it in a private strategy decks and investor memos labeled confidential. Because what's coming isn't just the opportunity, it's a recalibration of who controls the future of multifamily. This isn't about buying unit, it's about buying leverage. And the groups who see that first, they're already placing their bets. If you're looking for comps, you're playing checkers. The institutions are building territory. The only question is, will you be watching the headlines or writing them? A wave of $800 billion in multifamily debt is maturing. Rent growth is slowing, insurance costs are surging, cap rates are recalibrating in real time. But this isn't a collapse. It's a realignment, a consolidation. Institutional players aren't playing defense, they're hunting, and they're targeting precise geographies, asset classes, and operator profiles. They've done this before. After the dot-com crash, after 2008, each time they scooped up value while retail capital hesitated. This cycle is no different. Only this time, the scale is unprecedented. Billions in dry powder, faster data, more aggressive underwriting teams. They're not just looking for upside, they're looking for control. And they're about to reshape the market for the next decade. So here's how they're mapping it. 1. Demographic gravity zones. These are metros with 3 traits: inbound migration, diverse job growth, landlord-friendly regulation. Your top picks: Dallas-Fort Worth, Tampa, Nashville, Raleigh-Durham, Columbus, Ohio, Richmond and the Hampton Roads in Virginia. They're not choosing these markets by accident. They're using migration data, school enrollment trends, and U-Haul indexes to track movement in real time. See, these cities aren't just gaining people, they're gaining momentum. Momentum in wage growth, STEM employment, and state-level incentives. If capital flows follow confidence, then these are the markets full of conviction. They offer more yield, they offer narrative. In a time when investors are desperate for clarity, these metros offer predictability. Not perfection, but resilience. They also offer depth in employers, in industries, and consumer demand. And institutions are looking for sticky fundamentals, markets that just don't get rocketed by one factory closing or a single employer leaving town. They want layers: government, healthcare, logistics, education. The more insulated the economy, the more scalable the risk. And these metros, they're not just insulated, they're accelerating. 2. Class B and C submarket clusters. Institutions aren't chasing shiny new Class A towers. They're buying 1980s and 90s product with value add potential in zip codes with high median household stability. Targets: suburban submarkets with school district leverage, secondary metros with low new supply, workforce housing corridors near regional medical centers. Why? Because affordability is now a competitive moat. And Class B assets, when upgraded thoughtfully, generate outsized rent increases without regulatory exposure. Think $18,000 per unit CapEx to drive 300 plus month rent bumps. That's ROI traditional markets can't touch right now. These aren't sexy deals, but they cash flow, and they resist volatility. They attract sticky tenants, teachers, nurses, municipal employees, people who stay through cycles. The turnover cost in a Class A tower can be 3 to 5 times lower than a B-grade garden-style building. Institutions aren't chasing hype. They're chasing operational leverage. And B-class housing delivers that exactly. See, they can centralize maintenance across assets, standardize renovations, renegotiate bulk vendor contracts. Every lever scales. And when you combine scale with predictability, you get the closest thing to a guaranteed margin in real estate. 3. Regulatory refuge zones. With rent control spreading, institutional buyers are actively avoiding jurisdictions with the following: anti-renovation laws, strict eviction moratoriums, opaque permitting timeline states like California, New York, Oregon, or bleeding capital. Operators can't model revenue when policy keeps shifting, and institutions don't like guesswork. You see, they prefer environments where underwriting isn't a political risk. So they're doubling down in states with predictability. States like Florida, Texas, Georgia, the Carolinas, and Virginia. They're not just investing in property, they're investing in policy stability. Stability means you can't model 3 to 5 year holds without legislative curveballs. It means your renovation timelines won't be stalled by a council vote, and that kind of clarity is worth a premium. Even if the cap rate is a little tighter, the ability to operate freely more than makes up for it. 4. Lender alignment corridors. Institutions are clustering deals based on where regional banks are still lending aggressively. Southeastern credit unions, Mid-Atlantic CDFIs, Texas regional banks with CRE arms. Why? Because lender cooperation is half the battle. Because if you can close fast, you win deals before they hit the open market. These institutions are pre-negotiating financing packages before they even make offers. It's a coordinated strike. And in 2025, speed will be more valuable than pricing. They're building pre-approval pipelines, sending white-label deal decks to lenders before LOIs are signed. This is the new MO, cooperative financing with strategic lenders who understand the market. And because many small banks need to move capital to survive, institutions are securing preferential terms, lower rates, faster closes, flexible covenants. That's not just leverage, that's influence. And in shaping what zip codes, we see consolidation first. The result? Portfolio-based consolidation. Buyers aren't just acquiring buildings, they're assembling regional platforms. That means shared maintenance teams, centralized leasing, lower cost per unit in every major line item. They're not flipping assets, they're building scale. And scale wins in downturns. This isn't opportunistic investing, it's strategic dominance. And it's already happening while most operators are still re-underwriting 2023 deals. Institutions are moving now, not because they need to, but because they can. They're building efficiencies into the back end, shared data dashboards, central call centers, automated rent collection, virtual maintenance scheduling. They're turning fragmented assets into vertically integrated machines. And that means one thing, margin stacking. Every operational gain turns into increased NOI. Every 1% in savings gets multiplied across thousands of units. And that's how they can pay more upfront and still outperform. That's how they create equity out of thin air. And that's why the next 18 months will favor the fast, the scaled, and the prepared. So if you don't know your region's map, if you're not talking to lenders before deals surface, if you're not modeling CapEx across a portfolio, not a property, then you're already playing from behind. This isn't the time for single deal thinking. This is a territory war. And institutions are already drawing borders. The institutions aren't waiting, they're building. If you want to compete, stop shopping blindly. Start mapping like the smart money. The debt maturities are coming. The stress is predictable. The opportunity is geographic. In the next video, I'll break down the 3 indicators that signal a submarket is about to turn. So subscribe, tap the bell. The game is won before it's played. And let me show you why.